NBIS just snapped a brutal 30% four-day liquidation cascade with a violent 10.91% green breakout session. Retail momentum chasers think a major catalyst dropped, but this is a classic narrative stop hunt engineered by big tech noise. Nebius wrapped yesterday's session at $216.48, printing its very first green candle of July. It comes right after the stock got completely taken to the woodshed, dropping 30% as retail panic hit absolute fever pitch. Before we break down why the institutional buy side is aggressively bidding this structural dip, smash like and subscribe. To track live options, delta shifts, and private dark pool block prints before the crowd, hit the description link. The entire Neocloud space got nuked last week because of Meta. Rumors leaked that Zuck is launching an enterprise compute platform to lease out excess GPU fleets. The immediate panic consensus was that the hardware trade was cooked. But think about the macro reality. If the AI infrastructure trade were truly over, would Meta be raising its CapEx guidance to spend hundreds of billions on data centers? Absolutely not. This isn't a macro demand cliff. Major investment desks like Morgan Stanley and UBS dropped tactical notes confirming the street completely overreacted. Meta is likely leasing out legacy compute clusters while hoarding next-gen silicon for internal training. Why did NBIS get hit the hardest then? Because as a pure-play AI cloud infrastructure provider, the retail herd feared Meta would transform from a high-volume client into a direct, margin-crushing hyperscale competitor. The market tape is completely contradictory right now. While bears scream about a GPU capacity glut, Google is simultaneously restricting compute access due to physical supply constraints. The underlying demand remains insatiable. Elite analysts are pointing to the Jevons paradox. As the absolute unit cost of specialized AI compute drops, enterprise adoption velocity scales exponentially. Cheaper compute actually triggers a massive demand explosion. Furthermore, Nvidia is actively expanding its cloud co-selling and revenue share programs. When the ultimate gatekeeper of global silicon continues to lean heavily into the Neocloud architecture, it is way too early to call a top. On the technical chart, the sell-off flushed perfectly into the $190 handle, colliding right with the major weekly BBI trendline support. We flagged this exact zone on our watch list as a prime structural accumulation pocket. Looking at the Bloomberg terminal, institutional price targets span a conservative $248 average to an aggressive $287 upside ceiling. Smart money isn't abandoning the asset class, they are exploiting the local volatility window. My desk's conclusion: this 11% squeeze isn't just a random dead cat bounce. It's a structural realization that Meta's infrastructure optimization does not threaten dedicated bare metal AI clouds. The long trend is intact. Let's test your active conviction. Does this sudden NBIS reversal mark the launchpad for a clean structural breakout to new highs? Or do we fade back to test the macro trend support? Drop your technical analysis below. To capture our real-time institutional entry clusters, automated options order flow sheets, and private Discord workspace alerts to front-run the next high-beta tech rotations, hit the links in the description right now.